And now I give the floor to Amanda. You're welcome.
Well, thank you for having me here today. It was a long flight and I feel very sleepy. I hope you are awaker than I am, and I hope you will enjoy the paper. This is co-authored work with James McNulty. He is also from Florida Atlantic University, and he has done substantial amount of work on banking in emerging and transition economies. So he has some expertise in that. The title of the paper is relatively lengthy, but what it tries to capture that we're trying to introduce a new measure of efficiency of banking sector. As of today, it's titled Interest Rate Spreads in Emerging Markets, an application to the banking system of transition economies of Central and Eastern Europe. And we mostly focus on these countries due to the specifics of how the banking system was developing over the period of time after transition and during transition. But we do control for other countries, including developed and developing countries as well. So let me start with motivation. I have a few slides on motivation to explain why we were interested in this specific research question. First of all, efficiency of financial and specifically banking system is quite important, and there's plenty of studies that have been done in this area to illustrate that the level of banking development really affects economic growth and countries' prosperity. Levin's summary of functions of financial intermediation, this is not inclusive, but most important roles that banking system plays are mobilization of savings, which is the way to transit funds from savers to productive sector of economy. Monitoring firm performance, which is also quite important to find good projects to invest into. Managing firm-specific risk, which is an additional layer to control for the riskiness of project that firms take. Allowing firms access to better technology, because if firms don't have enough funds, they have to obtain it from somewhere else. And one way to do that through banking system or market financing through issues of equity. Developing systems of corporate control, which is quite important in current environment, especially after 2000s, where we had a lot of examples of failure on corporate management to do the proper job of companies' management. Most of the prior studies that looked at the banking efficiency, they looked at balance sheet measures of banking sector or banks to perform this analysis. And some examples of the studies, not of course all inclusive, include King and Levin 93, couple of papers from them in that year. Levin and Zervo 1998 and Levin 2003. These studies mostly, if not all, find that there's a positive relationship between the financial development and the rate of economic growth. So the bigger the banks, the better their balance sheets, the better the growth, economic growth in the countries of studies. However, the implicit assumption that the studies make is that a larger financial system is efficient or it wouldn't have become large. The question we try to address here or ask is whether it's really applicable to all type of countries and banking systems. If we look specifically at transition economies, which include post-Soviet countries and Eastern Europe countries, the opportunities to accumulate wealth were limited there for households for quite a long period of time, up to 70 years prior to transition, and therefore there is no sufficient base for this banking system to have large size. So the financial system in transition economy have an efficient intermediation process that would not be evident through the size of the balance sheet of banks. Of course, we're not saying ex ante that they are efficient, but theoretically we could argue that if they could be efficient, which is not measured properly. There were some studies done on emerging markets that also try to look at other measures besides balance sheet, and specifically I have a few listed here. such as Discussant from IMF, and I'm not sure how to pronounce the names, Huizinga, 1999, Draco, 2003, and Kasman and et al., 2010, where they tried to look at the net interest margin, which is somewhat similar to the measure we're proposing. And specifically, the way it's measured is the bank interest revenue minus interest expense as a percentage of earning assets. And what it would imply that lower measure of net interest margin would transform into a more efficient banking system. Okay. However, what we're trying to argue here is that NIM is not necessarily the best measure of efficiency, even though it's in line with our argument why the measure of difference in rates would be important besides balance sheet measures. The reason for it not to be the most efficient is that it's ex post accounting measures in comparison to what we're suggesting to use as market measures. The bank interest rate spread is a more appropriate measure because it looks at the concurrent market quotes of the deposit and loan rates, which is in concept similar to the measure of net interest margin, but NIM is, as I said, exposed and also may have some other faults in terms of accounting adjustments, which I will mention a bit more as I compare these two measures a bit later. Our study is based on theoretical work done by Fry, 1995, and King and Levin, 1993. Where the theories tell that a wide spread between loan rate and deposit rate is an indicator of an efficient financial system. King and Levin's model also implies that a larger spread can affect the real growth rate. And I'll go over these models just a little bit more in detail in a minute. So what we're trying to suggest that the spread can be a particularly good measure of banking system efficiency for transition economies because, as I said, the size of bank system may not be appropriate to capture the efficiency, and it's better than a net interest margin because it's a market measure instead of exposed accounting measure. Before I get to a statement of hypothesis, I'm going to go over findings just in case if I'm cut short at the end of my presentation. What we're finding that interest rate spreads are negatively and significantly correlated with every traditional measure of financial intermediation that were used in prior studies, with the largest magnitude of correlation for transition economies. So we do find support for our suggestion that spread can be a proper measure for banking efficiency. We use a sample of 19 transition economies available in the data set, and we control for a group of 64 developed and developing countries for the period of 1995 to 2007, which is before crisis, and we cut our data period there just to avoid some contamination of the results, but obviously we could be asked to extend the study to current period to see if it really support our findings in current time. What our main findings are that the spread is negatively related to economic growth. So the effect of banking efficiency measured through spread is in the direction that we would expect, that less efficient systems lead to less growth. The spread is affected by inflation, GDP per person, and agriculture as percentage of GDP, and the percentage of urban population in both sub-periods where we divide for shorter periods of 1995 to 2000 and later period of 2001 and 2007. And we also find that transition economy status, inflation, GDP per person, agriculture as percentage of GDP, and rule of law also affects traditional measures of financial intermediation. So this is in line with our expectations that they are comparable measures, the prior use of balance sheet based as well as the spread, but we suggest that spread may be better for especially transition economies. Let me quickly go over the literature just to give you a bigger picture of what's available. And I was just informed by Laura that I missed some studies that may be relevant to what we're doing, so she will fill me in on that. And first of all, the balance sheet measures of information that were used in most of the studies, these four: bank assets per capita, which is the size of banks or bank system, liquid liabilities relative to GDP, total domestic credit relative to GDP, and claims in private sector to GDP. And the reason to subdivide them here, just to look at the actual sources of the economic growth from production that would be financed from loans. Again, here's the list of again, not full list, but some examples of studies that have used these measures. And all of the studies look at the efficiency of banking system measured with these balance sheet measures. There's also a few studies that looks at stability of financial systems and efficiency related to stability. Not many studies looked at transition economies, but there are some. Specifically, there's theoretical study by Gordon and Winton, 1998, that argue that there may be some differences in transition economies that would lead to differences in banking system development and efficiency. And empirically, Harper and McNulty, they looked at the transition economy effect, and they find there's a significant substantial effect of the transition economies on the banking sector efficiency. As alternative measures of intermediation, as I mentioned, there were a few studies that looked at net interest margin, which is again bank interest revenue minus interest expense as percentage of earning assets. And the most related study is by Dragos 2003, where he looks at 11 transition countries, individual banks level data to see whether this measure explains the efficiency. And he does find result that we are looking for too, that larger margins are associated with less economic growth and efficiency. Other studies, such as second one, Discussant and Huizinga, 1999, they looked at the larger set of countries beyond just transition economies, but for the shorter period of time. They also look at the profitability of the banks and effect on economic growth. And the last listed on the slide, Kasman et al., they worked in similar lines, but different set of countries and different controls on the country level and the time period. In terms of interest rate spread, there are no, apparently we were not so careful to find, but we were not aware of any study that looked at cross-sectional analysis of interest rate spreads and effect on economic growth. There was a white paper, IMF paper, but De Nicola et al. In 2003, a couple of papers that looked at the spreads in transition economies using univariate analysis. They do find a lot of variation in this measure across countries as well as across time, which suggests that a lot of differences and probably different factors affecting this measure. They talk about reasons for such huge spreads, and they argue that the most driving effect coming from the higher rate on loans than in deposits, though higher deposits rates are necessary in a high risk and inflation environment to attract funds by banks. But what they suggest that high loan rates are actually more hurting than higher deposit rates. And they argue that this high interest rates and spreads coming from high credit risk that was present in transition economies at that time. I have one slide just to explain the difference between spreads and net interest margin measures that were used in few studies that are comparable to other analyses. First of all, net interest margin partially reflects loan deposit transaction made by many years early, because if you look at composition and maturity of these loans, you may have long-term assets, long-term assets loans there that may not be really representative in the current conditions or current performance of the banks. Also, NIM is reduced by non-performing loans since they do not generate interest, and the net interest margin is affected by a percentage of government bonds in the portfolio. This generally yield lower interest rates than loans, and other measures of assets and liability composition, as well as ratio of earnings assets to total assets. So what we argue, again, this is not very reflective of the efficiency because there's some lag in time, as well as the difference in composition of portfolios across different banks. The spread, we argue, is not affected by these factors, and is this more precise measure of cross-country differences in ability of banking system to transform deposits into loans. So before I move on to hypothesis, let me briefly explain the models that we're using to justify our hypothesis. This is a graph borrowed from models by King, Levin, 93, and Fry in 1995. What it shows here that on the y-axis we'll have real interest rate, and x-axis will have growth rate that would be affected by the interest rates available in economy. And the Ramsey curve represents the supply of deposits or funds from, for example, households. And with high interest rate, you would expect to have high growth rate as consumption would be postponed, which will translate into investment in the capital, forward-looking capital. The downward slope or Romer curve represents the demand on demand on loans, and is downward sloping due to the diminishing production rate on capital. Here's another, I don't know, this one doesn't. Another line that represents the net Romer curve, which creates a wedge between the possible net return that banks could generate from lending and the actual cost that intermediaries would carry. So the wider the wedge, or the spread, or the difference between loan rate and the deposit rate, the higher the cost for the intermediary or banking system. As you can see, that leads to decrease in the growth rate. So economies would be growing at lower rate. And also, King and Levin look at the wedge as a tax or some possible measure of cost on the banking system in transforming deposit into loans. So what they also suggest, as there's a higher tax or the wedge or spread here, then there will be lower demand on the financial intermediation as well, and therefore the assets of or the size of the banking system will be declining. So that leads us to our three hypotheses. The first one, that bank interest rate is negatively correlated with traditional bank balance sheet measures of financial intermediation. As I mentioned, that the larger the spread, the less demand for the intermediation or bank loans would be in place. The second hypothesis is related to the shift in the graph here that leads to declining growth due to the bigger spread. So the bank interest rate spread is negatively related to economic growth. And the last hypothesis we have here, based on the empirical studies that exist, we compare whether the determinants of the traditional measures are similar to the interest rate spread that we're proposing to use. So we hypothesize the determinants of interest rate spreads are similar to the determinants of other more traditional measures of intermediation. Briefly about the data. Data comes from different sources. Lending rate, deposit rates, and the information on the balance sheets of aggregate level, of course, on countries, comes from IMF's International Financial Statistics dataset. We also collect explanatory variables from World Bank World Bank development indicators, such as GDP, inflation, population, agriculture's percentage GDP. Supplementarily, we'll get literacy rate and urban population from World Health Organization. And for the control of political risk or legal protection, we get that data from Political Risk Services database. The sample period 1995-2007 was split into sub-periods just to explore explore how the transition economies change in their status, and we would expect that to happen. So we'll look at 1995 to 2001, and then 2001 to 2007. Just to give you a visual picture, the sample of countries, we have not full but quite representative sample for transition economies, including former Soviet Union as well as Eastern European countries. Developed countries are a bigger set, but for developed countries, due to the bias of the data set we use, there's not so many available from the developed countries, but there's some present. This is the result of correlation analysis that relates to our first hypothesis. So what we find here, that for the early period on transition economies, there is significant correlation of spread with all the traditional measures. This correlation actually increases in size, so it's still negative, but it's more pronounced after 2001. And we find less correlation of spread with other financial measures of balance sheets for developing countries, but it's still present especially for the later period for some of the measures, and it's a little bit more pronounced for developed countries, especially for the later period of time. So there is a support for our hypothesis that spread is negatively correlated with the traditional measures, especially for transition economies. The second hypothesis we test with the cross-sectional analysis of panel data, where we control for the country fixed year fixed effects. We don't use country fixed effects because we have transition dummy here that captures the transition economy status. But we find that for early periods spread, dependent variables, real economic growth, and we find that it's negatively affected by the spread, which is not really captured by other measures in earlier period. And the later period, we find even stronger result. And for the assets, bank assets per capita, we find positive relation, which is expected. For the third hypothesis, where we explore, almost done, where we explore what factors affecting the spreads, we find that there's, especially for later period, I will consider that one. Transition economy is negative. Where is it? Transition economy is negatively related to spread. Is negatively related to. Okay, I will concentrate on the on explained variables here. That some common factors are present for the measures, which is consistent with our expectation that spread would be affected the same factors as traditional measures, and we perform also additional robustness tests with the interaction term of transition economies and other explained variables, and I'll skip on that. Results are similar. And one more thing I want to mention that we do propose that, given that if interest rates spread is better measured than traditional bank efficiency measures used before, then there should be better databases created to capture the variation across country in this measure, and probably adjust for some ways of how they reported and quoted. In conclusion, the results are consistent with all three of our hypotheses. The spread is highly negatively correlated with 4 conventional measures of financial information for transition economies. The spread is negatively related to economic growth, and the spread, similar to other financial information measures, is a function of a country's specific economic, social, and political characteristics such as inflation, economy size, GDP per capita, proportion of agricultural output in GDP, and urban population and rule of law. Okay, sorry I was a little bit over time.
Thank you so much. The discussant is Laura Solanko. You're welcome.
Not to break it. Change the. Thank you. This is. Put it here. Yes. Thank you so much.
Thank you. Thank you for the. Thank you for the opportunity to discuss a very, very rich and very interesting paper. There we go. No, that didn't work. This one works. Okay. Trying to very briefly wrap up what the paper in my reading does, and where the contribution of the paper is. The authors use interest rate spread in describing banking sector performance cross-country from 1995 to 2007. And what they find is that the interest rate spread and economic growth are negatively related, one thing. And then additionally that the spread and a number of measures of financial debt and measure on banking sector liquidity are negatively correlated, and those are shaped by similar factors. And these conclusions apply, in my reading, to transition, developing and developed economies. So that's very briefly my reading of what's done in the paper. It's very rich paper, and therefore my concern is that it's a wee bit too rich. That there's sort of that would benefit from having a clear focus on one of these issues. Since I'm not really sure where the focus currently is, and I think there are several potential arrows that you could put more effort on. It's whether is the main focus in analyzing banking sector development in transition economies. That's very possible. Is the real focus, motivation to prove that spread is a superior measure? If so, then there are some further questions. Or is the main focus in analyzing finance and growth? Or then lastly, at least in the text, you refer in many occasions to banking sector efficiency. So is this paper actually about banking sector efficiency? I have something little to say about various of these bullet points. I think any of these would be a viable and good option to focus. There's certainly room for further research in any of these, but it would probably help not only the reader but also the authors if you sort of would make it clear from the beginning of where the contribution is. If it is about banking in transition, then there's lots in the paper that could be added. There's I may be biased now in citing a bunch of very good survey papers, but at least I think that those are really good papers to start with, and start with thinking on what has happened in banking in transition, and then if that's the thing, then also there's a paper that was published in 2005 that it has the focus on transition and growth. It's a fixed effort panel model on growth, and it uses interest spread exactly the same measure you as an explanatory variable. They use data from 95 till 2010 2, if I'm not mistaken. So there's certainly room to upgrade and update that. But at least that's something you may know. Then if the focus is, don't mind if you don't get to read this, I'll explain what here is. If the focus is to prove that the spread is a superior measure, then it would be helpful if that you argue that why particularly spread, what makes spread. I mean, this is just a printout from World Bank's World Development Indicators on what they have in banking sectors. And this is just to show that there are plenty of various kinds of things you may potentially think about. And on top of these, there are another bunch of variables from the World Bank's financial inclusion databases that may also have something to do. So at least if you want to pick one superior measure, then it might be helpful to make a horse race between various indicators and see then which one provides better R-squared or something. But now sort of you're just picking one and saying that this is better, but there's no sort of a real proof of that. But that's sort of, there clearly are plenty of alternatives that you can horse race your favorite measure against. Then on the time period, apologies for, you probably cannot see. Anyhow, this is just from the same World Bank World Development Indicators database, just the interest rate spread downloaded from there, separated from Central and Eastern European and the Baltic states, which is the light green, plop. Then OECD is the black dotted. The black line here is Russia, which you also have in the sample, if I'm not mistaken. East Asia and Pacific. Upper middle income, which is pretty much the current reference group for many of the European transition economies. And then the green line here, Europe, Central Asia. So thinking on the time period, if you just take one measure, there's actually a whole lot of happening here. The 1995 to 2000 probably looks radically different from latter period. So some more of sort of on thinking on how these variables behave may be helpful. Then if it's finance and growth that you really want to explain, then I would urge you to be clearly more careful in sort of explaining the data span, the variables used, and making it comparable to other studies of finance and growth literature, making sure that you have the variables are comparable to things that have been done earlier. And then probably I misunderstood, but I somehow had an understanding from the paper that what you used in the growth is pooled OLS. We may discuss that. There's no robustness checks, but that's I mean, once you know what the focus is, that's easy to add. And then finally, if it actually is banking sector efficiency that you are interested in, then it would be useful to contrast your results with the existing literature on banking sector efficiency, which usually is based on bank level data, on good or bad. Usually people use bank scope data, which we all know is certainly not perfect, far from that. But anyhow, then that's the literature and that's the conclusions you wish to contrast your results with. So I think it's a very good idea and certainly many avenues, but more work needed to focus it and then refine. Thank you very much.
Thank you, Doctor.
When I read the paper at home, a question that struck my mind is, what about competition? It seems that the main driver of high spreads would be lack of competition. And it would seem that lack of competition and uncompetitive banking system would indeed lead to lower growth. So the issue story just about incompetitive financial systems. And there's no mentioning about competition, at least not that I read. And I also don't see it in the tables. So that's like a huge elephant. Another elephant in the room.
Favorite phrase for the day.
It's in the favorite today. We found another elephant and it's roaming the place here. And, so I think you need to think about this, about competition. And a second question, in your motivation, you talk about accounting measures and forward and backward looking, and you say we need the interest rates. But how is the interest rates that's in the IMF actually calculated? Is it not calculated by looking at the accounts of the banks and just calculating an implicit interest rate? Or is it the actually advertised interest rates?
It's not calculated. It's according, we have a footnote there that specifies how exactly it's calculated by the database. It's quoted. Quoted rate on loans of specific maturity, long-term or mid-term maturity. And
it's what central banks happen to report.
But so it's interesting to know how they do it. So they have reported interest rates, but how do they weigh, for example? So did they take the average of all banks, or do they give a bigger weight to big banks, or? I mean,
well, that's
there's a name on the paper.
No, that's why we suggest that we should have a better measure for the spread.
Or we should not precisely how they calculate it, because that's what you pay for your
I mean, it's like when Russia publishes those. And that's the macro figure.
Yeah, but what do they, how do they do it? You want to know, because that's very important. So let me put it this way. If you have a banking system with one really big bank and two small banks, and the big bank has 90%, and they just take the average lending rates, then they are wrong.
I agree with your
with the 50 banks, equally spread.
concern, but so there's no way to check how this was measured and just quoted and quoted. And my guess is similar to developed economies where it's just quoted on prevailing point rate or whatever rate is available. And similar is probably done in other countries, but it's aggregate level, so you cannot really know the microstructure of that in terms of only technical level. And that's why we think that's a better way to look at the issue, because it would be readily available aggregate measure to look at the efficiency instead of dealing with bank or data that is messy and you don't really know what you're getting there.
I'm asking for the following reason. So imagine you have the raw data. So one other thing that would be very important is the spread. You have the variation. So you have the interest spreads that may be just an average with hugely different numbers. If it's hugely different and you just the average spread, what does it mean? It means a lot of uncertainty. Is that? But if there's a very small uncertainty, very small band, and a small spread, so also the volatility of the spread.
Ideally, you would want to have, in addition to the spread, the volatility of the spread in that specific country, which is in other literature, corporate finance, for example, there's several measures perfect in other databases. It's not present, so that's what we hope to have.
Okay.
Other questions or comments?
Thank you.
My question is about the model specification. You specified this as spread as a dependent variable and some measures of economic growth as explanatory variable. What about the potential endogeneity here? Because you said that you found some correlation between these two measures, financial efficiency of financial intermediation and economic growth, but these could also go to other directions. So if you specify a model in this way, so you saying that growth is a factor of spread, but spread could also explain economic growth in terms of, if the loan rate is small, then a lot of loans are directed and economy is growing and so on. So how do you deal with this?
Well, first of all, we base it on the theoretical expectation of existing theoretical model. So we're not just randomly selecting something that was the latter was relating. That why don't we just look at different measures available and say why pick this one? Because we're looking at something that was mathematically justified. in terms of indigeneity, it's been a problem in any finance research, and to deal with that, of course, you would want to create some instrumental variables, but your question is not about indigeneity. What you're saying here, it may be a causality problem that we have issue with, right? I mean,
no, my question is about this specification, is it correct in terms of potential indigenous problems? I mean, a specification of one equation model specification. When you're saying that causality, or I don't know how to say, runs only in one way. Because when you specify this model, you're saying that particularly that only growth explains the spread, but not vice versa. So
we actually have the other way around. We have that spread affects the growth. So spread is the explained variable of the growth. That's what we have in mind. And now the other way around. We're saying that the spread is the factor that explains the growth, and that's the measure for the banking efficiency. Maybe it was not clear from the tables, but I didn't specify the model on the slides, but it's actually the other way around. You see what I'm saying? The growth is the dependent variable.